Welcome to the deep dive from everything you need to know about finance.
Hello.
Today, we're tackling a big one, something you probably hear about almost daily if you follow the markets or, frankly, just the news.
That's right. We're diving into the NASDAQ 100 index.
Exactly. And our goal here, using the information and data we've gathered, is to really understand what it is, how it actually works, and what its track record looks like.
We'll break down what the data tells us about its history and structure.
But first, really important point. Nothing we discuss here today constitutes financial advice.
Absolutely critical. We're just exploring the information available about the index itself.
Yeah, this is purely for informational purposes. Any investment decisions, those need to be made with a qualified financial advisor who knows your specific situation. Investing always involves risk.
Couldn't agree more. So the NASDAQ 100, you hear the name constantly. It's often used as shorthand for, big tech performance.
Right, or just the really influential companies shaping things today.
But as the info shows, it's actually a bit more complex than just being the tech index. There's more under the hood.
Okay, let's pop that hood then. Let's start right at the beginning. What exactly is the NASDAQ 100?
So at its heart, it's a stock market index. It tracks the performance of equity securities issued by 100 of the largest non-financial companies listed on the NASDAQ stock exchange.
Non-financial.
Yeah.
That jumps out immediately.
Yeah.
Why is that exclusion so significant?
Well, it's defining characteristic compared to other major indices. It deliberately filters out the entire financial sector.
So no big banks, investment firms, insurance companies, none of that.
Correct. No commercial banks, investment banks, insurers, brokerage firms, mortgage lenders, they're all excluded. If you wanted exposure to those types of companies on NASDAQ, you'd look at a different index, like the NASDAQ Financial 100.
I see. So taking those out must give it a pretty distinct flavor.
It definitely does. It leads to a heavy concentration in other areas, most notably technology.
Which makes sense, given NASDAQ's history. But is it only tech companies then? Or just dominated by them?
Dominated is probably the right word. Looking at recent data, technology makes up something like 62% of the index weight, so it's huge.
62%, wow.
Yeah, but it's not exclusively tech. The remaining portion includes companies from quite a few other sectors.
What else is in?
Things like manufacturing, healthcare, consumer goods, both staples and discretionary spending industrials, telecommunications, even utilities and basic materials.
Okay, so it's broader than people might think, even with that massive tech weighting. You've got your software giants alongside, companies making goods or providing essential services.
Exactly. It captures a pretty wide slice of the large non-financial economy listed on NASDAQ.
Mm-hmm.
But yes, that tech component really drives its personality, you could say.
And how does it decide how much influence each company has? Is it just the bigger the company, the bigger the impact?
It uses what's called a modified capitalization weighted method.
Okay, modified cap weighted. Break that down a bit.
So capitalization weighted means a company's weight in the index is generally proportional to its total market value, its market cap. Bigger companies have a bigger influence.
Right, that seems standard. What's the modified part about them?
The modification involves specific rules designed to prevent the absolute largest companies from becoming too dominant. It puts limits on the maximum weight any single company can have, and also on the collective weight of the largest companies.
So it tries to maintain some balance, even though the giants still have the most sway.
Precisely. It stops one or two behemoths from completely dictating the index's movement, although, the Apples and Microsofts of the world still have a very significant impact due to their sheer size.
Speaking of which, based on the recent data we have, who are those heavy hitters at the top right now?
Well, the names won't surprise you. We're talking Apple, Microsoft, NVIDIA, Amazon, Meta, formerly Facebook, of course, Broadcom, both classes of Google shares, so Alphabet A and C, Tesla, and Costco Wholesale.
Yeah, pretty much a list of the most talked about companies globally.
They are huge, and their performance really matters for this index.
Okay, so that's what it is. But you mentioned it's an index. You can't just buy the NASDAQ 100 like a stock, right?
Correct. It's a benchmark, a calculation. You gain exposure to its performance through investment products that are designed to track it.
Like ETFs, exchange-traded funds.
Exactly. That's the most common way for many investors. The big one is the Invesco QQQ Trust, ticker QQQ. It's one of the most actively traded ETF out there.
QQQ, right? I think I mentioned another one too, QQQM.
Yeah, the information notes QQQM as well. It also tracks the NASDAQ 100, but generally has a lower expense ratio, which might appeal more to, say, long-term buy-and-hold investors.
Interesting. So ETFs are key. Any other ways to track it?
Sure. There are mutual funds that follow the index, and for more sophisticated traders, there are futures, contracts, and options based on the NASDAQ 100. Some annuity products might also be linked to its performance.
Okay. Lots of options.
Yeah.
Now, how does this index actually stay current? Companies grow, shrink, merge, new ones list? Can't be static.
No, definitely not. It has regular reviews and adjustments to keep it relevant. The main event is an annual rebalancing, sometimes called reconstitution, that happens every December.
The big yearly shakeup.
Pretty much. NASDAQ looks at all the eligible companies listed, ranks them by market cap as of late November, and then applies rules to decide who's in and who's out for the next year.
What are those rules generally?
Well, the top 75 eligible companies by size are automatically kept or added. Then there's a buffer zone, companies ranked 101 to 125. They only stay in if they were already in the top 100 the previous year.
So a bit of stability for existing members just outside the top 100.
Right, but if you're in that 101, 125 range and were in the top 100 before, you're out. And anyone ranked below 125 is dropped. Regardless, any changes get announced ahead of time.
Okay, that's the annual refresh, but I think you mentioned other adjustments too.
Yes, there's also quarterly rebalancing. This isn't usually about swapping companies, but about adjusting the weights. It gets triggered if the index becomes too concentrated.
Concentrated. How so?
For example, if one single company grows so large, its weight exceeds 24% of the index. Or another trigger, if all the companies that individually have a weight of 4.5% or more, when added together, make up 48% or more of the index total.
So if the big players collectively get too big relative to the rest.
Exactly. If those thresholds are crossed, NASDAQ steps in quarterly to tweak the weights and bring them back below those limits.
And didn't something like that happen outside the normal schedule recently? A special rebalance?
Good memory. Yes, that happened on July 24th, 2023. It was triggered because a really strong rally, especially in tech stocks and Tesla, had pushed the combined weight of the top few companies over that 48% threshold.
So they had to step in and dial back the weights of the biggest stocks.
Correct. It was done specifically to address that overconcentration issue and bring more balance back to the index. The materials note this kind of special rebalance has happened before, though it's not common.
Fascinating. It's like actively managing the influence of the superstars. Okay, let's shift to performance. This index has a reputation, right? High growth potential, but also volatility.
That's a very accurate reputation. Looking at its history since it started back in January '85, it's been quite the roller coaster.
I bet the dot-com era stands out.
Oh, absolutely. It rocketed up to about 4,700 points in March 2000, the peak of the bubble.
And then?
And then the crash. By October 2002, it had fallen. Wait for it. 78%.
78%. Wow. That's a brutal drop.
It really underscores the potential downside, especially when a dominant sector corrects heavily. After that, it started climbing back, but then got hit again during the 2008 financial crisis.
Right, the global recession.
Yeah, it fell below 2,000 and bottomed out around 1,018 in November 2008.
So another major setback. What's the story since that 2008 low?
Well, since then, despite some bumps, the overall trend has been strongly upward. It crossed 3,000 back in 2013. Then you see these periods of really rapid acceleration, like gaining 1,000 points in just 103 trading days to hit 10,000 in 2020.
That's incredibly fast growth.
It is. And more recently, the data shows it moving above 21,000 in 2024, and it even hit an all-time high just over 22,200 in February 2025.
Trajectory is amazing. But the annual returns data paints a more varied picture year to year, doesn't it?
It really does highlight the volatility. You have absolutely stellar years. Look at 1999, up over 101%, or 2009 after the crisis, up over 53%. 2013 was nearly 33%, 2019 almost 38%, 2020 over 47%, and 2023 was another huge one, up almost 54%. 2024 also started strong, up nearly 25%.
Massive gains in those years. But then there are the counterpoints.
Exactly. The flip side is harsh. The dot-com bust saw 3 straight years of heavy losses, 2000 down almost 37%, 2001 down nearly 33%, 2002 down over 37%. Then 2008 wiped out almost 42%. And even as recently as 2022, it was down nearly 33%.
So it really emphasizes that this index can deliver huge returns, but also suffer very significant drawdowns. It's not a smooth ride.
Not typically, no. When it moves, it tends to move decisively.
What about the QQQ ETF that tracks it? How has that performed over its lifespan?
So QQQ launched back in March 1999. Since then, its average annual total return has been about 10.09%.
Okay, around 10% per year on average since 99, which includes those big down years.
Correct. That average smooths out the peaks and valleys over more than 2 decades.
The material had a specific example over a more recent 10-year period, right?
Yes, a good illustration. It showed that if you invested $1,000 in QQQ at the beginning of January 2015, and importantly, you reinvested all the dividends you received.
Okay, dividends reinvested.
By the start of January 2025, so 10 years later, that initial $1,000 would have grown to $5,431.98.
Wow. From $1,000 to over $5,400 in 10 years. That's substantial.
It is, and for that specific decade, 2015 to 2025, that works out to an annualized return of 18.44%, a total return of over 443%.
That's incredible for that specific period, but it also highlights how much the time frame matters, doesn't it?
Yeah.
That 18.44% is way above the long-term 10% average.
Absolutely. That decade was clearly a very strong bull run for the types of companies in the NASDAQ 100. It shows the compounding potential during good times, but you have to remember that long-term average incorporates the tough periods too.
Definitely puts recent performance in context. So recapping the ways to invest, we have ETFs like QQQ and QQQM, mutual funds, futures, options, maybe some annuities.
That covers the main ways to get exposure.
Now, thinking about its day-to-day or week-to-week movements, what kind of news or events seem to influence the index based on the information we looked at?
Well, the snippets of news often linked to large price moves are revealing. You definitely see reactions to broad macroeconomic data, things like job reports, inflation numbers, interest rate decisions.
Big picture economic stuff. Makes sense.
Yeah. Also, geopolitical events can play a role, like mentions of U.S.-China relations impacting the market. Given the global nature of many NASDAQ 100 companies, that's not surprising.
And what about factors closer to the index itself?
You see mentions of flows into the tracking ETFs like QQQ. Large inflows can create buying pressure on the underlying stocks. And crucially, given the index's structure, news about specific key sectors is important, like chipmakers rallying.
Because tech is such a large component.
Exactly. And perhaps most directly, the earnings reports and major news from the very largest companies in the index, and earnings beat from an NVIDIA or an Apple can significantly lift the entire index just due to their heavy weighting.
Right, the performance of the giants really echoes through the whole thing.
It's a mix of individual company health, sector trends, and the wider economic environment.
Okay, I feel like we've covered a lot of ground here. We've defined the NASDAQ 100, really homed in on that non-financial aspect, and its tech-heavy but still diverse makeup.
We looked at how it's weighted, how it gets updated through those rebalancing processes, annual, quarterly, even special ones.
And then we spent a good amount of time on the performance history. The dramatic highs, the painful lows, the year-by-year volatility versus the long-term average, using that QQQ example. Plus, how you can track it and what influences its price.
Hopefully, you now have a much clearer understanding of what this index represents and why it gets so much attention.
Yeah, it helps make sense of the headlines. So thinking about everything we've unpacked its specific focus, excluding financials, that heavy tech concentration, the modified weighting still giving huge influence to the top names, and that history of really big swings, both up and down.
It does lead to a final thought, doesn't it?
It does, based only on these characteristics and the historical performance data we've discussed today. What might that tell you about the particular kinds of potential risks and rewards that come with tracking this specific index compared to, say, a broader market index? Something to definitely mull over.